A few weeks ago, a homebuyer in Texas sat at a closing table preparing to sign a mortgage agreement. 30 years, fixed rate, just over 6%. Before signing, he asked a question most people never think to ask. Why exactly is my rate 6%? The lender smiled politely and gave the standard response. That's simply where mortgage rates are right now, which sounds reasonable until you realize it explains absolutely nothing. It's basically a professional way of saying, that's just how things are. But rates don't magically appear. Someone, or something, determines them. And the answer isn't your bank. It isn't your local lender. And it's not even directly set by the Federal Reserve. Instead, it's driven by a massive financial market that most people never pay attention to. A market so enormous that it dwarfs global stock markets combined. A market that quietly influences mortgage rates, car loans, business borrowing costs, rent increases, retirement accounts, and even job creation. Most people never see it, yet it helps determine the cost of almost every major financial decision in their lives. This video isn't really about bonds. It's about understanding the hidden system that influences how money moves through the economy. Because once you understand that system, you'll start seeing financial news, interest rates, and investing very differently. I'm Morgan, and I've spent an unhealthy amount of time studying a market that somehow manages to be both incredibly important and unbelievably overlooked. If you've ever wondered why borrowing suddenly became expensive, why home affordability collapsed, or why supposedly safe investments lost money, you're in the right place. By the end of this video, you'll understand a part of finance that many people never learn, even after years of studying it. So let's make this simple, because the financial world loves making easy concepts sound complicated. At its core, a bond is nothing more than a loan. That's it. One side needs money, the other side provides it. Governments issue bonds, corporations issue bonds, even local municipalities issue bonds to fund projects. Instead of borrowing from a bank, they borrow directly from investors. An investor hands over money today. In return, the borrower promises two things. First, regular interest payments. Second, repayment of the original amount on a specific future date. Simple. When the U.S. government spends more money than it collects, it issues Treasury securities. When large corporations want funding, they issue corporate bonds. And when financially weaker companies borrow money, they typically have to offer higher interest rates to attract investors. Wall Street likes calling these high-yield bonds, which sounds much nicer than their older nickname, junk bonds. Same thing, much better marketing. Now here's the concept that confuses most people, and it's arguably the most important idea in this entire video. Imagine you purchase a bond for $1,000 that pays 2% annually. You collect $20 every year. Nothing exciting. Then a year later, interest rates rise. New bonds now offer 5%. That means investors can buy a fresh $1,000 bond and receive $50 annually instead of $20. So here's the obvious question. Why would anyone buy your older bond? They wouldn't. At least not for the same price. Your bond still works exactly as promised. But compared to newer bonds, it's far less attractive. The only way to convince someone to buy it is to lower the price. As the price falls, that fixed $20 payment represents a higher percentage return to the new buyer. That's how the market adjusts. And that's the key relationship that drives almost everything we're about to discuss. When interest rates rise, existing bond prices fall. When interest rates fall, existing bond prices rise. They move in opposite directions. That single relationship explains countless financial events, market crashes, banking failures, and economic surprises, and it all starts with one number that quietly influences nearly every corner of the economy. Now let's talk about the number that quietly influences almost every major financial decision in America. If you could boil the entire economy down to a single benchmark, this would be one of the strongest candidates. Not the stock market, not Bitcoin, not the unemployment rate, the yield on the 10-year U.S. Treasury. At the moment it sits somewhere around the mid-4% range, and whether you realize it or not, that number affects you a lot. Because when a bank decides what interest rate to charge for a mortgage, it doesn't pull a number out of thin air. It starts with a simple question. If I can lend money to the U.S. government and earn a certain return, why would I take more risk lending to an individual homeowner? The answer is simple. It needs additional compensation. That's why mortgage rates tend to sit above Treasury yields. The government is viewed as one of the safest borrowers in the world. You are not. No offense. So lenders add a premium to account for uncertainty. Job losses happen. Businesses fail. People miss payments. Governments rarely disappear overnight. The result is that Treasury yields become the foundation upon which countless other interest rates are built. When Treasury yields move higher, borrowing becomes more expensive throughout the economy. When they move lower, borrowing generally becomes cheaper, and history gives us a perfect example. In the early 2020s, Treasury yields fell to exceptionally low levels. Mortgage rates followed. Home loans reached levels that would have seemed impossible just a few years earlier. Suddenly, buyers could afford larger homes with similar monthly payments. Demand exploded. Prices surged. Competition became intense. People rushed into the housing market because cheap financing dramatically increased purchasing power. Then everything changed. Inflation accelerated. Central banks responded. Interest rates climbed. Treasury yields followed. Mortgage rates jumped. And the housing market quickly lost momentum. Monthly payments increased dramatically. Buyers stepped back. Sellers became reluctant to move. Transactions slowed. The same house now required hundreds, or even thousands, more dollars each month to finance. The property didn't change. The financing did, and financing changes everything. But housing is only one piece of the puzzle. Businesses feel it too. Imagine a company that borrowed heavily when money was cheap. Maybe it locked in loans at 3%. Everything looked manageable. Then those loans mature. Now the company needs to refinance at 7%, or 8%, or even higher. Suddenly, interest expenses double, profits shrink, expansion plans disappear, hiring slows. Sometimes layoffs begin. Because when borrowing costs rise, businesses have fewer resources available for growth. That's one reason interest rates ripple through the entire economy. They influence hiring decisions, investment decisions, expansion plans, even wage growth. But here's where things get really interesting. The bond market doesn't just react to the economy. Sometimes it predicts what's coming next. In fact, one of the most closely watched recession indicators comes directly from the Treasury market. Normally, investors expect to earn more for lending money over longer periods. That makes intuitive sense. 10 years is a bigger commitment than 2 years. Longer commitment, higher reward, simple. But occasionally, the opposite happens. Short-term Treasury yields move above long-term Treasury yields. This unusual situation is known as an inverted yield curve, and historically, it has earned a reputation for being one of the most reliable warning signs in finance. Why? Because it often signals that investors expect weaker economic growth ahead. They're willing to lock in long-term returns because they believe future rates may eventually fall. In other words, they're preparing for tougher conditions. No indicator is perfect. Nothing in finance is. But this signal has developed a remarkable track record over decades. That's why professional investors, economists, policymakers, and analysts watch it so closely. While headlines focus on daily market drama, the bond market is often quietly sending messages about where the economy may be headed next. And sometimes those messages arrive long before everyone else catches on. Here's the strange thing about the bond market. Most people spend their entire lives being affected by it without ever realizing it exists. Every mortgage payment, every car loan, every business expansion, every retirement account, every interest rate you see on a screen. The bond market is sitting somewhere in the background, helping determine the price. And yet almost nobody talks about it. Not because it's unimportant, but because it's invisible. The stock market gets the headlines. The bond market writes the rules. Today you've learned the one relationship that drives almost everything in this system. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. It sounds simple, but that one idea has helped shape housing markets, triggered banking crises, shaken governments, and moved trillions of dollars around the world. You don't need to become a bond trader. You don't need a finance degree. And you definitely don't need to memorize every economic report that comes out each month. You just need to understand the forces that quietly influence your financial life. Because whether you're buying a house, investing for retirement, building a business, or simply trying to make smarter decisions with money, these forces affect you whether you pay attention to them or not. The difference is that now, you're one of the few people who can actually see them. And once you see them, it's hard to unsee them. If you enjoyed this video, hit the like button and subscribe for more deep dives into money, investing, economics, and the hidden systems that shape our financial world. Thanks for watching. And I'll see you in the next one.